Hello, everyone, and welcome to our webinar. We are just going to have a few moments to let everyone join us. Thank you for taking the time to join us today. Our webinar will be starting in a couple of moments. We're delighted that you're joining us from across the globe, and we look forward to this discussion with you. So we're just going to have a couple of more seconds to let a few more people into the room, and then we'll shortly begin. Okay, so let's start. Hello, everyone. Thank you for joining us today. So we're delighted to be hosting this webinar here in Oxford in support of the Oxford Private Equity Programme. This webinar is our annual occurrence with Professor Tim Jenkinson and Chris Kallos, and they'll be walking us through what we'd like to think of buckling up for 2026, looking at the current and emerging trends in private equity. I know that we are very happy that it's the afternoon here in Oxford, but we'd like to say a very big special thank you if it is early morning where you are or evening. So thank you for joining us. Just a couple of housekeeping points. This webinar will be recorded and you will receive the webinar within the next few weeks. So just if you haven't been able to make it here today, we will be sending this to you later. We'd also like to mention that throughout the conversation, we will be taking questions. So if you do have any questions, please feel free to put it in the Q&A portion of the webinar, which can be found in the lower part of your screen. So if we could just move on to the next slide, please. Thank you. So as mentioned, this webinar will be hosted by Professor Tim Jenkinson and Chris Kallos, who I have the delight of working on for the Oxford Private Equity Programme. This webinar will run approximately 40 to 45 minutes, so plenty of time, as mentioned, to go through your questions, which will be reviewed throughout, and also perhaps for some Q&A if we don't run out of conversational time. So without further ado, I'd like to move on and introduce you to Professor Tim Jenkinson. Over to you, Tim.
Thanks very much. And Chris, it's always lovely to see you for our annual catch up on what's going on in the private equity industry. So thanks for joining us again. I suppose I've been talking at a lot of conferences recently, and the first topic that everybody talks about is liquidity, or rather the lack of liquidity. So is the drought continuing? This is the sort of payouts from funds where there's been fewer exits in recent years. But what's your view about what's happening there? Is it continuing, and do you expect it to ease a bit in 2026?
It is continuing. I do expect it to ease. There are a number of factors that I think are causing us to be optimistic that that will be the case. We'll talk, I think, later about some new vehicles or newish vehicles that are helping the cause. But the lack of liquidity is driving a number of things, and I do think it's going to thaw increasingly over the next few months. So the IPO window seems open, unclear, how far open and how long it will remain open. But that has a cascading effect on this issue. So not only do IPOs sometimes, often not immediately, provide liquidity, they do kind of build confidence in valuations. And so if you see a company that was being carried at one value on the books from the sponsor go public at a higher value and then trade up, it helps build confidence in the valuations in the rest of the portfolio, and that confidence can give you some confidence in whether you're over or under allocated to private equity, and that can then help drive your ability to commit to new funds, even if you haven't gotten all the liquidity that you were expecting yet.
Yeah. And how do you think this is all going to play out? Because obviously the funds have got a lot of dry powder, and so it's not like it shouldn't really stop them doing deals. But on the other hand, the investors don't really want to commit to new funds until they've got some money back. So is it clogging up the system and the fundraising side more than the deal making side, do you think?
I think you're right that it's clogging up fundraising more than deal making, but I think it's important to remember that the dry powder isn't sort of evenly distributed. And so for individual, funds, while there may be, dry powder in the system, a particular manager might be concerned about the amount of its dry powder it has, when it will be able to raise new funds and trying to make, the best investments it can, and maybe being very selective in the interim, or maybe making, smaller investments out of the fund and offering more co-investments. So, the lack of liquidity is impacting, I think, both the deal market and the fundraising market. But I think you're right to observe that it should and I think does affect the fundraising market much more significantly.
Yeah. And let's talk a bit about continuation vehicles. We've spoken about those in the past, and these are where a deal or a bunch of deals is put into a new vehicle, and the for the GPs to continue managing them, and then the LPs, the investors, are given a chance to roll over into this new vehicle or get their money out. And it seems like those have been really taken off, even in the last year since we last spoke about them, and seem to be a significant source of liquidity that has actually been in the market. Although in a way it's a bit strange because a lot of the investors who come in, I mean, the assets are still there in a sort of in an illiquid form, but there's new investors who come in to get rid of the old investors, as it were. So give us a sense about whether you think that has been a big source of a sort of solution to this illiquidity problem.
Yeah, it's been definitely helping solve the problem. The continuation funds are booming right now and have been for at least a year or two. Um, Remember that the money for the continuation funds, the people leading those deals on the buy side, the folks that are providing the cash to make those transactions work so that LPs who want to take money off the table can, those are typically led by dedicated funds for this space. And the kind of boom in activity in this space has also been paired with a boom in fundraising. So there is a lot of money coming into large secondary funds to invest in these continuation vehicles. So it's maybe ultimately can't coming from a lot of the same group of investors, but it's coming from kind of newer committed pools to do this, and that liquidity is helping address the fact that that market is currently liquidity constrained. So there are not enough dollars right now chasing those deals, despite these large fundraisers on the secondary side.
Yeah.
You might kind of do a simple demand and supply equation and say, well, maybe that makes it a good deal to be on the buy side if they can be super picky and be very aggressive in their pricing. And there's probably some truth to that, at least for the time being. But I think that'll probably mitigate over time.
Yeah, and for those people who aren't so familiar with these, I mean, one of the sort of the ways in which they're a bit criticized is that it's almost like the buyer and the seller are the same person. That the fund is selling it to an SPV, a special purpose vehicle that they will also control, and so there can be some interesting incentives there. But how is that dealt with within these structures? To make sure that they aren't in any way sort of like preferencing the new investors or indeed the old investors.
Sure, there are concerns that have been voiced from both regulators and from in the investor community about ensuring these are not kind of coercive. So you have to recognize where the LPs kind of sit. A lot of these LPs are liquidity starved, so they may be economically incentivized to take the deal and sell. Um, I don't know that that's a particular regulatory concern. I mean, that's something that the LPs is a problem kind of their own management, and I don't know that there needs to be sort of a lot of concern around the fact that there are a lot of motivated sellers because of their own liquidity needs. However, there are some other things that make it difficult from the existing investor side. One, The groups that made the original investments, their talent and experience is primarily in evaluating general partners to manage blind pool funds. They, at least a large percentage of them, are not staffed up to do the diligence and pricing and valuation work to independently develop a view on whether the portfolio company, the individual operating company, or companies that are subject to the deal, whether they're getting a good or bad price. So, if you don't know what it's worth, it's hard to, make that decision, and, you may default to selling. You also, may need, under your own internal documents as an LP, to do a whole new underwriting and get whole new approvals for the deal. And that may take time, and it may take more time to run through that process than you have, or it may be something that's not a great use of, your internal resources to go and process that, which would also, bend towards you selling. And then finally, it's not really necessarily the same investor. So you may have, if it's a sovereign, it's the same investor that's, in the fund and deciding whether to roll or to sell. But in a lot of the LP community, it may be a separate pool of capital. So you may have a fund of funds that was formed in 2017 and was Fund 5. And now, that same investor's on Fund 7. And, Fund 5 is out of capital and not in a position to make new investments. And, it's really an investment decision for a different fund, Fund 7, either because that's just how their internal workings are, or because with some of these deals, there is a dry powder commitment that goes along with the roll. So you may be rolling, but you also may be providing some fresh capital for add-on acquisitions, et cetera. And, some investors are not well positioned to be able to do that or do that quickly.
Right. Yeah. And I think that probably explains a bit like why I was at a conference recently where the figure was given to me that 80 to 90% of the existing investors do not roll into the continuation funds, which really surprised me. But maybe some of those behavioral reasons, like they just don't have the governance to make a call on an individual portfolio company, could be really binding here. And so it might be that that's part of the reason, as well as liquidity demands, but just not being able to make that type of decision might explain it. But is that broadly the way that you've heard that sort of percentage is not
Yes.
Rolling?
Yeah, that's I think broadly people's expectations. I think that is skewed a little bit by the fact that if there's not a very high percentage of people exiting, the transactions tend not to get done. So, the secondary players don't want to, you know, invest in something that's going to have like 10% of the company. So, they typically will be, for a variety of reasons, including it doesn't put enough of their capital at work in that deal to justify all the time and effort on the deal. So if they're, and positively that impacts the price for the sellers, it sort of increases the price to get to the point where there are that many, that high percentage of people selling. But I think if it were a deal where only 40% of the people wanted to sell, that deal just typically would not get done.
Right. Okay. Let's move on to fundraising a bit, because obviously one of the areas which is booming in fundraising is secondary funds to do this sort of thing. But that's a smaller chunk of the market. What about the main market for buyout funds and indeed VC, if you are aware of that? So how's it been the last 6 months, and what's it looking like for the future, do you think?
If we talk primarily about, buyout funds of all sizes, maybe rolling in growth equity, excluding venture and real estate, because those are, somewhat different cycles and different markets. The fund sizes are, continuing to get larger, but not by a large amount. So they're growing. The fund sizes are growing somewhat. The number of funds is down, and it continues to be down. It's well off the 2020 to 2022 highs. We'll probably beat out 2024 in terms of number of funds, but it's not a lot of champagne corks popping every week on fund formations. That said, we see a big part of the market, and we have announcements, if not every day, every other day, of funds that we've closed. So there are funds getting done. Some of those funds even have the pricing power and demand to have very quick oversubscribed fundraisers. But for most funds that are getting done, if you see a fund closing announcement tomorrow, there's a good chance that fund was in the market for, at least a year, possibly longer. So there are some very quick ones, but the aggregate time to final close has hit kind of I think it's a high of 25 months on average. That's very long.
Wow.
Previously, you would have thought, if we were having this conversation 2 years ago, I would say, well, people used to talk about a year, now it's really 18 months. I think now it's getting closer in practice to 2 years. So it might say 18 months, but then, maybe the first close gets delayed a bit, and then maybe there's an amendment to extend it beyond 18 months to, 20, 24 months. So the fact that the average is 25 was surprising even to me. Something might be skewing that a bit, but in sort of anecdotally, we're definitely seeing things, longer fundraisers than we've seen as recently as a few years ago.
Yeah. Yeah. And what sort of things do you think, I mean, in general terms, that resonate with investors these days? Are they still looking for things like, operational capabilities or sector focus or I mean, obviously track record is always important, but did you get a sense as to what GPs or what factors are making some GPs be very successful?
I mean, if you look back enough years, you get to a level where, access and proprietary deal flow was a huge factor. I think that has shrunk dramatically, although it's still a relevant factor for some firms, especially as you get towards sort of hot growth sectors and things like that. There are a lot of large private companies, and getting access to that is still limited. And people who have access to those kinds of opportunities, I think, see some more demand. But most deals are auctioned, and while not every deal goes to the highest bidder, most deals go to at least one of the highest bidders. And so whoever's buying and paying that price needs to have better ideas of what to do with the company than the people that they outbid. Otherwise, they're not going to get the projected returns that they want. And so things like operational skill, the ability to add value to these companies in one way or another is still important. And sometimes is the driver of that. But I wouldn't say that's become table stakes, but it's becoming more widespread. So a very large percentage of the buyout funds at least claim to some level of operational teams and groups that are doing things in the companies. I think if investors look at what they're doing, they'll see that is, varies widely across funds. I mean, I'm sure they're all doing some operational improvements, but some of it is at the kind of turn a wrench on a machine level, and some of it is at negotiate better financing, maybe upgrade certain departments, things like that, and then it runs all the way through. Improving top line growth, I think, is becoming groups that can do things to meaningfully help companies scale their revenue, their top line, continues to be valued, and I think some folks are differentiating themselves in that way.
Yeah. Let's take a slight detour for a second. We're going to talk mainly about private equity, but we can't really, it's becoming increasingly difficult not to talk about the private debt funds these
Yes.
days because they're providing a lot of the financing these days for the debt side of the private equity funds. And we've got a question in the Q&A saying, like, do you think the recent scandals, with First Brands and like is gonna, have an impact on that? It strikes me it's not clear that these particular examples have got much to do with the private debt funds that I see sort of being very involved in financing buyout deals, because this looks like the normal factoring or sort of invoice financing, which has been a big area in the past. But of course, mud sticks sometimes, even if it's in a different area. People are now talking about you can't open the FT at the moment without there being a lot of people worrying about the private debt market. So what are you seeing in the US? Are there similar concerns there? Are we at peak credit funds now, do you think?
I don't. We should talk about that whether we're there and when we would get to peak credit funds, and what does that really mean? But I would say, to answer your first question, there is a lot of debt in the private equity. I mean, it sounds obvious, but like the scale is maybe not immediately apparent to people. If you put 20% down to buy a company, that means there's 4 times the debt as there is equity, right? So you get to 100% by adding 80% of the financing and debt. So there is a multiple of debt in the system. Banks have not fully retreated from this, but they've been replaced to a significant degree in lots of these deals by private credit providers. And so they're playing a legitimate role. I think people smarter than me can consider how interest rate changes are going to affect the availability and profitability of that industry. It's a kind of a complicated question, but I think there are a lot of private credit providers. There is a lot of demand from investors in those kinds of products. They offer, at least currently, pretty attractive risk-adjusted returns. A lot of this debt is secured debt. A lot of it is in companies where that security is really valuable, and so I guess I'm not that concerned that there is a lot of private debt, in the system. And I kind of like the fact that it's in some ways more diversified than having a few banks taking all this risk. So I think there is a lot of credit and a lot of private credit as opposed to what we've had before. And here I'm talking about private credit from basically private credit funds. Because of that demand, that's driving a bunch of things, including the valuations of firms that are in that business providing private credit. Unlike you can slice and dice equity a fair amount, but you can slice and dice credit even more. Lots of levels of credit that you can provide, and some people specialize in providing one tranche of that credit. Others provide the full stack of credit. But that business and the firms that are doing it are that's booming, and so you're also seeing a lot of folks either starting credit product lines within their large existing funds, and so offering credit funds, sometimes very specific to the kinds of deals they're doing, sometimes more broadly, and in many cases acquiring credit teams and credit fund managers, where they're not, instead of building it, they'll buy it. And so there's a lot of M&A activity in the private credit fund manager space. So people selling either minority stakes or majority stakes or the whole firm to folks that are looking to either get in or expand their business in the space and to be able to scale very quickly while the opportunity is huge.
Yeah. No, it doesn't seem to be. It seems to be continuing to grow, doesn't it? And I think that it's an interesting one because in some ways, some of the it's not exactly that the banks aren't still in the business because they often will provide leverage to the funds, but the funds stand as the first loss guys in this, don't they? So it's sort of it's a slightly different framework now where the banks are not really, you could argue, aren't taking as much risk as they were before, which may be good from a systemic
Or
risk
not,
point of
or
view.
maybe not incented to, right? But I think in terms of your question about peak credit, I guess obviously with all the transactions happening of people buying managers in the credit space, there's at least one side of the equation that thinks that we're not close to peak credit, right? You're buying and you're expecting that to that to be a good deal and that business is going to grow significantly. So I don't think we're there. I don't think it's exactly on the horizon. It could be just beyond the horizon. So I don't know that we're 10 years away from peak credit. But when you say peak credit, at least what I'm saying is this rapid growth leveling off. I don't think we are going to have a peak and a crash. I think it's going to stop growing at this rate because there are limits to how much credit can be in the system for you got to have the private equity funds and the deals to support that. And I think it will start to level off at some point. I don't know whether that's in 2 years, 4 years, or 6 years, but it's probably not in 10 years. But I don't see that as this isn't a situation, at least from what I expect and see, where you're going to have a peak and then a rapid decline. I think you're going to have a peak and kind of a leveling off.
Yeah. Can we move then on to the investor fund relationships, because those can sort of have a dynamic of their own, especially in periods where it's harder to raise money. Sometimes some investors can get preferential deals or like when funds are pretty anxious to raise capital. Are we seeing many changes in the way in which certain investors can negotiate their deal from the GPs?
Uh, I mean, it's a continued evolution of something we've been seeing for some time. Some of it is sovereigns and whether it's sovereign wealth funds at the kind of country level or large U.S. state pension plans and things like that. So whether you're using kind of large pension plans or by states or by countries or actual wealth of the country, we're seeing a lot of those groups that want to put large amounts of capital behind strategies or firms that they have high conviction in, negotiating various kinds of arrangements with those sponsors. So it could look like there could be an investor who wants more say over their investment, and so they may, sort of pledge to large amount of capital to deals that the sponsor will source on a maybe co-investment basis. They may be putting money into a product that then invests across the sponsor's funds. So instead of doing a new underwriting for every fund, they're going to negotiate something where they will invest across funds and commit to a series of funds or across product types. And in both of those cases, one of the drivers is to cut fees, right? To be able to pay, less per dollar to have that money managed by offering up that level of committed funds or semi-committed funds.
Yeah, no, that makes sense. And in terms of the sort of the other big story, I guess, that's come out in the last year is, and it's being, of course, driven by the US, where there's been a more permissive attitude towards sort of it's not quite called, not often put as democratizing private equity, but allowing more investors, maybe even going down into retail investors, to get access to private assets in general. So obviously been some legislative changes or executive orders which have sort of mandated that. Um, how real is that now in the US? Like, where is it go? How is it going? Like, is it going into 401k, personal pension plans? Is it coming in through the wealth platforms? Is it getting to the ultra high net worth individuals or the sort of the man on the street or woman on the street? Where is it going and how fast?
Sure, sure. I mean, I don't know if a lot of the folks tuned in are World Series fans, but if you excuse the baseball, U.S. baseball or World Series baseball reference, we may, of 9 innings, we're probably in the third or fourth. I mean, it's still early. Lots of things could happen. There's a lot more discussions around this and sort of broad concepts of, the U.S. government seems more open to having um, retail investors, at least through their pension plans, including their 401k plans, getting access to the private companies that while they're still in the earlier stages of growth. So companies used to go public earlier in their life, and some still do, allowing that value accretion from that point forward to be captured by the public. Now a lot of that value growth is happening while the companies are still private. And I think there's an understanding that that's going on and an interest, at least in the current administration, to invite more people to that party, I guess I would say. Um, what's actually happening, the easiest folks to access that are people who are already, at a more retail product, are people already high net worth investors. And so, um, there's a wide range of high net worth investors, but if you're in the, let's say, 30 to $50 million net worth category, there are a bunch of advisors who have, access not just to the funds, which you've always had, some level of access to, but to co-investments, individual deals. And so some people want to tap that, and the advisors have, I think, moved things pretty significantly over the last, call it 2 years, to offering that level of high net worth client access to co-investment opportunities as well as fund opportunities. So that's happening. I think when you get down to high net worth individuals, below that level, there are feeder funds. There's some access opening up as these advisors are really, I think, more aggressively going after that market and trying to find solutions to get them into private equity funds. And so that stuff is happening. Some of it's already happened. Some of it is, I think, very much in process. On the pension fund side, I think it's very early days. I think there's, kind of an agreement by the administration that that's a good idea. But I think for people to act, there needs to be, more clear rules and things. Pension administrators have a lot of exposure to what they, to their participants based on what they offer and things in, at least in U.S. pension funds. And so I think to get the administrators comfortable, there's going to need to be some more evolution. But I think that's happening. And then there are types of private equity funds, BDCs being one, that are increasingly finding ways to offer assets to the broadly defined public. So not necessarily people who are going to be filling out forms and agreeing not to sell these interests to other people, but something that is more liquid and more accessible. I think that's all coming. In the meantime, I guess I maybe caution people a little bit that if you're getting an opportunity and you are not in those categories that we mentioned, but somebody comes to you with a private equity opportunity, assume that a lot of people said no before it came to you, right? So the best, it's not just getting the public access to private equity, starting from the bottom of the ladder where people can't, of opportunities where they're looking for investors because no one wants to buy it. I think the idea is to give investors access to a broad range of private equity opportunities so that the public can get into not just the most desperate funds, but the most sought after funds. I think that's going to take some time. I think there are definitely I don't see the highest quality venture funds that are already not increasing their size dramatically, at least most of them. They don't have any trouble raising money, and I don't think they're going to go beyond maybe this ultra high net worth channel. But others, particularly that are raising very, very large funds, you need more capital. As I said, fundraising is difficult, and so I think they're much more incentive. If you're raising a $20 billion fund or a $10 billion fund, these getting $1 billion or more from the retail channel, it becomes very interesting.
Yeah, it seems to me that those wealth advisor channels are going to be the next sort of step that this goes through, and that's going to, and I'm curious, like, do you think there's going to be a bunch of like evergreen vehicles which are produced here? I hear that there's quite a few of those being sort of set up. And how do you think those are going to work? Because even if they're evergreen, if the underlying assets are illiquid, it seems to me you can't really give people sort of the liquidity is going to have to be limited on those, maybe every 6 months or 3 months, or annual liquidity, or limited relative to the amount of money you've got invested. But are you seeing those sort of structures coming
You're
about?
you're hearing some talk and also some concern about terms like partially liquid,
Mm.
and I kind of concur with you. Like partially liquid is looks more like liquid until it looks more like not at all liquid, and so it's an inherently illiquid asset. And so, adding liquidity is something that's inherently illiquid without dragging down the returns by holding a lot of cash or other, very liquid securities in combination with it is challenging. But there are people trying to solve that challenge and, you know, trying to manage cash flows and liquidity windows to make this more liquid. And that's part of what is, potentially even necessary for the 401k and other individual pension um, channel to really open up, because the assumption in your 401k plan is that you can press a button and get the money out. There
Yeah.
may be a tax if you're not of retirement age, but that those funds are available to be withdrawn. And if they're not really available to be withdrawn, then having that as an option for investors, particularly investors who may be actually unsophisticated, is is something that the regulators and the companies offering this are going to need to manage through.
Yeah, it just seems like with the demise of the defined benefit pension scheme, who are always the natural holders of illiquid assets,
Mhm.
that there's going to be, in countries all around the world, there's going to be this push towards getting for the defined contribution pension schemes one way or another. And I think you can see a lot of the big providers tooling up to do that through some of the alliances. You see some of them alliances with index providers and others who seem to be trying to come up with ways of sort of benchmarking private equity, which seems like quite almost coming up with almost like a neutral product or very highly diversified product. So I think we're going to see a lot more here.
Yeah, there's definitely interest, and there's a lot of like solving that puzzle will be very valuable. And so there are a lot of people looking to solve that puzzle in a variety of ways,
Yeah.
including the ones you mentioned.
Yeah, I think so. Okay, let's just move on to a couple of final topics of so Edward, I teach twice a year my venture capital course in Silicon Valley, and there everybody, obviously for the last couple of years, has been saying that all they're doing is AI. Now we're not really focusing. I mean, even in the course, we have some sessions on venture, but I think it's clear what's going on there. What are you seeing in the on the buyout side, where, after all, the bulk of the money is, or the growth in the buyout side, not just in terms of like whether they are changing their sort of investment thesis towards sort of AI centric companies, or how is it? Are you seeing it being used at all by the GPs themselves, by the fund managers? Are they implementing AI solutions?
Yes. So there is I mean, I'm usually suspicious of when people say, this time it's different, but I think
Mm,
this time it's different. I don't think we've seen in our lifetimes, with the possible exception of COVID, demonstrations of exponential growth and exponential improvement, and what that really means. And I think that's what we're experiencing. And so I'm a believer that it's going to transform industries, including mine, and maybe destroy profits in some places and create much like I think in the U.S. AI may be the savior of general practice medicine, which
mm,
most general practice doctors are telling their kids not to go into medicine, mostly because of all the stuff that doesn't really look like being a doctor, and AI may take care of a lot of that stuff. So it's going to change lots of industries. Not to state the obvious, there is a huge amount of investment in it. Not to restate what everyone knows. Um, and I think it's hitting lots of places. So I think what we're seeing in the fund side is a lot of AI focused fundraising. And some of that is, at the venture level, investing in AI companies. Some of those are co-investments in these companies that are a year or two old, but are already at very large values and need a lot of capital. And so they're raising capital in the private markets. And there are people that want to, including ultra high net worth individuals who want to get in on that. And so you're seeing products designed to provide capital to those companies. Some of that is, equity capital, so venture and growth equity capital. Some of it is, various forms of debt, structured leasing, and you've probably seen reports in the press about some of these, multi-party deals that are, at least people are raising questions of, what's going on in this sort of circular financing.
mm,
I think people are probably getting too excited or too worked up about that. I think that a supplier or a company investing in its customers or providing financing to its customers is not unusual in other industries. And so I think that there's a lot going on. I think you can break it down into people who are financing startups and growth equity into this space. And there's tons of, investment. A lot of that money, I think everyone understands, is going to go to zero, but the ones that don't go to zero could go, beyond the moon. So there's a lot of stuff, a lot of funds and investment activity in that space at, the technology level, actually hardware level, and the data center level, but also in LLMs, application layers, very industry specific verticals. So there are multiple companies that are a year or two old claiming to be, the company that's going to completely transform the legal industry. You can also take that to consulting and accounting and all these other
yeah.
spaces. So it is, I think, bigger than the internet kind of investing cycle that we went through. Um, both the dot-com and the other phases, the fiber and everything else. This feels much bigger than this. I think people think there's a lot more on the line in a variety of ways. So there's tons of activity.
Yeah. And in terms of transforming the way they do business, do you
Yeah,
see
so I
much
think
where they're sort of saying,
yes.
okay, maybe we invite our AI agents along to the investment committee meeting or maybe
I
that,
haven't quite
they
seen
may
that
be,
yet, but you are seeing other things. So it depends on the like it you see in big industry, right? There are lots of large, Fortune 500 companies that are implementing AI in various ways. I've heard some criticism that they're not doing it right, and that's why they're not seeing the benefits of it. But eventually they'll do it right, and they will see, I think, huge benefits. So that's the operating company level. So that translating to the private markets, that's the portfolio companies of the private equity firms, not the ones that are actually AI companies, but the ones that are regular way companies that
yeah,
are using AI. So that's growing, and I think um, I expect it's a pretty common question from sponsors to their companies, like, what are you doing about AI? Just like that's a common question in larger companies. I think inside the sponsors, while there's a wide range, you're seeing it used in lots of different ways to accelerate diligence. I can't tell you that I've never received, a legal document from a client that said, "Hey, we wrote this with AI, please review," which is a bit of an interesting prospect. Uh, so they're bringing kind of lean principles, in some cases driven by AI, to the forefront. They're using AI, I am sure, in deal sourcing and evaluation and filtering things. I expect they're using it in reviewing the reports and information they're getting from these portfolio companies. Like, I'm not in the mix to see that, but I
yeah.
would be shocked if that wasn't happening.
Yeah, and indeed, that's one of the sessions on the course we're running in February, which is new this year, is one on the use of AI within how private equity is transforming, sorry, how AI is transforming private equity funds. And so
Mhm.
that will be very interesting to see that more focused on the internal mechanisms, because I think a lot of people are curious how that's happening. See it a bit in the venture world because they're very close to it, but actually even in the buyout space, I think it's
I'll stick around for
transforming
that session.
workflows. So
I'll stick
I
around
think
for that session. It sounds
we'll
interesting.
both learn something from that, which will be great. Chris, we could talk all day, but I was told we had to finish. It was right that we should finish after about 40 minutes. So at this stage, I just want to say thanks very much. Look forward to our sessions in February, and we'll hand back to Clara at this stage. So thanks
Thank
very
you.
much.
Thank you, Chris and Tim. It's been wonderful speaking to you both, and I hope people have enjoyed the session with both of you. We do have a handful of questions in the Q&A, but I do believe that we've answered them all for you during the conversation. However, if you do have any other pressing questions, please do feel free to contact me on the email below, and we'll try and endeavour to answer some of them. I'm sure Tim and Chris will look to see if there's anything that's missing from there, but thank you so much for your time today. Um, just as mentioned at the beginning of the call, so this call is in support of the Private Equity Programme and the Private Equity Institute, which is here at the University of Oxford at Said Business School. If you have really enjoyed your time listening to Tim and Chris, as I have, you'll be able to join them in person for 5 whole days here in Oxford in February from the 9th to the 13th of February, 9th to the 13th of February next year. There, the places are filling up quickly. So if you are interested in joining, we would say please put your applications in by the 30th of November. The QR code is there. In addition to this webinar, we are also sharing another webinar in 2 weeks' time, and this will be from 3 alumni who've had the pleasure of being with Tim and Chris in previous sessions. So we'll be seeing how they've used the knowledge that they have learned through the program in their respective markets, which are in the UK, in Malaysia, and Africa. So we'll truly get a global understanding of how these practices are being used after their time here with us in Oxford. Um, I just want to hand back over to Tim and Chris if they've got any final closing remarks before we say goodbye, and if there's any questions perhaps you'd like to answer beforehand.
No, thanks very much. There are some questions that we didn't manage to answer in the session, but some of them we did. So I think that some of them are a bit more specific, and maybe you can try to answer them offline. No, thanks very much, Cara, and thanks, Chris, again. And look forward to hopefully seeing some of you at in February or any of our other events. And if you're interested in this general area, there's a whole bunch of academic research that we're producing, which is all in the public domain. Just Google my name or Oxford Private Equity Institute, and you'll find access to all our research as well. And look forward to seeing some of you in the future. Thanks very much.
Thank you, everyone. Thank you, Chris. Thank you, Tim, and see you all very soon.